Okay, so let's start with a really big question. What if the biggest threat to your entire investment portfolio, it isn't a market crash, or high inflation, but the very index funds you've been told are keeping you safe?
That is the ultimate paradox we're digging into today. For decades, the gospel from people like John Bogle was simple, right? Stop trying to find the needle, that one stock, and just buy the whole haystack.
Just by the broad, low-cost index fund.
Exactly.
And for a long time, I mean, that worked beautifully. But now, here's the twist. The haystack, it's gotten so huge, it's actually become the needle. It's this massive choke point, a single point of failure.
And it's controlled by a handful of unelected gatekeepers. We're really looking at a systemic crisis where the cure, this low-cost passive investing, has, well, it's kind of mutated into a disease of capital allocation.
And when you say gatekeepers, we're talking about index providers.
Yeah.
Like MSCI, S&P Global.
Right, and they're not just neutral scorekeepers anymore. They've effectively become, well, quasi-regulators. They have the power to, in effect, debank a company from the public markets.
And not through laws passed in Congress or anything like that.
No, not at all. Just through a press release.
Right.
We're calling it enforcement by news cycle.
What makes this so urgent and why we're doing this deep dive now is that this isn't some theory. It just happened. We saw it play out in real time with MicroStrategy, with MSTR. I mean, their strategy was running for years and it was incredibly successful. But the second MSCI just proposed a rule change, just the announcement.
Yeah.
It wiped out billions in shareholder value overnight.
And that's the key detail. The stock didn't collapse because they lost customers or their software failed. It collapsed because the opinion of an index provider changed. That's it. And that created this huge uncertainty for all the institutional money that's mandated to follow their rules.
So a system designed for stability has created this massive choke point. It's a structure that can end up rewarding financial engineering more than, productive innovation. And it gives these unaccountable committees the power to decide who gets capital.
That's it.
Welcome to the Deep Dive. I'm Satosha.
And I'm Satoshi. Our mission today is really to break down the mechanics of this passive paradox. We need to understand how index eligibility itself became the single biggest driver of valuation in some of these cases. It's turned the market upside down.
To get there, we have to go back to John Bogle's original idea.
Right. His premise was purely mathematical. He said active managers as a group have to underperform the index over time. Their fees, their trading costs, it all eats away at returns. He was a huge champion of long-term stewardship.
He called all the market noise a giant distraction. But even Bogle, later in his life, started to worry. He asked, what happens if everybody buys the haystack?
Well, we're there now. That hypothetical is our reality. Passive funds now control well over 50% of U.S. equity assets.
And that shift is everything.
It is. Because they went from being price takers, just kind of following the lead of active investors, to becoming the dominant price setters.
And that's where the distortion really kicks in. Because a passive fund doesn't have an analyst looking at a company's fundamentals. The money just flows based on one thing.
Market capitalization. It's completely mechanical.
Which creates this momentum machine.
A self-fulfilling prophecy. A stock price goes up, so its weight in the index goes up. Then passive funds are forced to buy more of it, which pushes the price even higher. And this buying is totally price insensitive.
It doesn't matter if it's trading at 10 times earnings or 1,000 times earnings.
Doesn't matter at all. The fund buys because the rules say it has to. It's why some analysts have started calling this the dumbest market in history.
The irony is just, it's so deep. These ETFs, like SPY, they were meant to encourage long-term thinking, but they often have incredibly high turnover. So the tool for stability is now spreading volatility.
It's increasing correlation across the market, destroying the very diversification people think they're buying.
So before we get into the really fascinating story of MicroStrategy and how they exploited this, we do want to just take a moment and say thank you. The response to the show has been incredible.
It really has.
We started the deep dive with a pretty simple question. Is there an audience for this kind of deep, actionable research outside of, academia or a boardroom? And clearly, you're all as fascinated by this stuff as we are.
And to keep this going and to start creating the high-quality videos a lot of you have been asking for, we do need your help.
Yeah, we're trying to unlock funding for the Mosaic AI video editor. And the way we do that is by hitting 1,000 subscribers on all platforms. So if you're enjoying this, please take a second to subscribe on YouTube, Spotify, Apple Podcasts. wherever you listen.
That support genuinely makes all the difference.
And for this topic specifically, this whole collision of finance, tech, regulation, we put together an STRC course on YouTube. It's a set of audio deep dives that gets into facets of this world that the mainstream media just ignores.
We'll put a link in the description. If this is your area of interest, we highly recommend checking it out.
Okay, let's unpack it. The Bitcoin Treasury Flywheel. This was Michael Saylor at MicroStrategy.
Mm-hmm.
In August 2020, they adopted the Bitcoin standard, basically turning the company into a proxy for Bitcoin.
And it was an audacious strategy because Saylor saw the flaw in the passive system we just described, and he decided to weaponize it. A lot of big institutions couldn't buy Bitcoin directly.
Right, their mandates wouldn't allow it.
So they bought MSTR instead. This created this massive demand, and it drove MSTR's stock price to a huge, sometimes staggering premium over the actual value of the Bitcoin it held, the net asset value.
And that premium is the whole game.
Yeah.
It's what started what some people call the infinite money glitch.
Exactly. And so MSTR would issue, say, $1 billion of new stock and use that cash to buy $1 billion of Bitcoin.
Okay, but wait. Accretive dilution? Can you explain that? Because for most people listening, issuing more shares means their slice of the pie gets smaller. How does that add value?
That's the key term. Normally, you'd be right. But because MSTR was trading at that huge premium, let's say 50% above its Bitcoin value, they were selling their stock at a massive markup. So the cash they raised bought pure Bitcoin value. And after the deal, the amount of Bitcoin backing each existing share actually went up.
Wow. Okay, so it's a trick that only works if your stock is already seen as being way overvalued relative to your assets.
Precisely. And that powered the flywheel.
So new stock issue, market cap gets bigger, which then triggers the index providers to give MSTR a bigger weight.
Correct. And once that happens, all the passive index funds are then forced to buy the stock no matter the price. That forced buying supports the high premium, which lets MSTR issue even more equity, and the cycle just starts all over again.
It was a perfect exploitation of the momentum machine.
Yeah, it really was.
The critique, of course, is that MSTR basically stopped being a software company. It became a leverage holding company, a digital asset treasury company, just masquerading as a tech stock to get access to all that passive index money.
And that brings us to the moment the Quasi regulator stepped in. In late 2025, MSCI put out a paper. They proposed excluding companies if digital assets were more than 50% of their total assets.
And that was the spook, enforcement by news cycle.
A perfect example.
And the market reaction was just catastrophic. And so asymmetrical. I mean, the mere proposal, not even a final rule, it caused MSTR shares to fall over 50% in one quarter. Meanwhile, Bitcoin itself only fell about 25%.
That asymmetry is so telling. It shows just how fragile the whole structure is. And this brings us to the multiplier effect.
Right.
Analysts figured the total passive money at risk of being forced to sell was around $2.8 billion, but the actual market cap loss was tens of billions, more than 10 times that amount.
Which proves the point. Index eligibility isn't just about the money flowing in from the funds.
No, it's a primary driver of the valuation multiple for the entire stock. Losing that index inclusion is a signal to everyone that the stock is basically uninvestable for any large mandated institution.
And the final blow came on January 6, 2026. MSCI backed off from kicking them out completely, but they did something more. Surgical.
They did. They put a freeze on the number of shares that index funds would use for their calculations, specifically for these digital asset treasury companies.
And that was the shot that broke the flywheel.
Absolutely. It means that, okay, MSTR is still in the index, but passive funds are no longer forced to buy any new shares the company issues. The ATM has been shut off. Its growth mechanism has been de-indexed.
So it's basically a private entity regulating a public company's ability to raise capital, without any of the due process you'd get from, say, the SEC.
Is it a fair analogy, though? Couldn't you argue MSCI is just protecting the integrity of their own product, their indices? What really makes them a regulator?
I think the difference is in the coercive power. When your decision, a rule change on paper, can cause tens of billions in wealth destruction and stops other companies from even trying innovative new models, you're exercising regulatory force.
It connects right back to that Mark Andreessen critique. Regulators don't always need a law. They just need to spook the market, create enough uncertainty to scare capital away from a whole sector.
So threatening to de-index a company is like the capital market version of Operation Choke Point.
Exactly. You're being debanked from the public markets. And these index providers are enforcing these rigid 20th century ideas of what a company should be. They're like the system's antibody response to anything disruptive, like the MSTR model.
And there does seem to be a bias. I mean, look at Tesla. It was added to the S&P 500. It was a hugely speculative bet on building factories, new tech, massive operational risk.
A bet on productive enterprise.
Right. But MSTR was financial speculation. It was hoarding a bearer asset. The fact that they singled out DADCOs when you still have, gold miners in these indices, it suggests the committees are enforcing a certain monetary ideology. They seem much more hostile to financial engineering than to operational risk.
So if we accept that they are acting like quasi-regulators, then we need to talk about remedies. How do you fix a system with a choke point this dangerous?
Let's start with Bogle's original vision. Remedy 1. Mandatory holding periods.
This is probably the most direct fix. You could require investors in these big index ETFs to hold their position for a minimum time, say 6 months, maybe a year, to get favorable tax treatment or avoid fees.
It would stop all that sloshing around of capital.
It would dramatically reduce it. It forces a long-term horizon back into the definition of passive, and there are precedents like India's ELSS schemes.
Okay, Remedy 2. This one targets the core mechanical flaw MSTR used, the capitalization weighting. You shift to time-weighted index methodologies, a TWAP.
Yeah, this is a more sophisticated fix. So instead of the index weight being based on today's price, which is what fuels that flywheel, the weight would be based on a time-weighted average price over, say, the last 12 months.
So if a stock price suddenly spikes, the index basically waits to see if it's real before forcing all that passive money to pile in.
It breaks that instant feedback loop. It adds some much-needed friction into the system.
Makes sense. Okay, Remedy 3 is about the gatekeepers themselves, designating MSCI and S&P as systemically important financial market utilities, SIFMUs.
That's a huge designation. It would subject them to federal oversight. They'd have to be more transparent, publish their meeting minutes, have clear and objective criteria for inclusion.
Get rid of the black box.
Exactly. But you can imagine the resistance to that. The private sector will fight hard against that level of oversight.
Of course. And the final one, a corporate governance solution. Loyalty shares. L shares.
This is about shifting power back to long-term owners. A company could issue shares that get more voting rights, say 2 votes instead of 1, but only if you've held the stock for more than 2 years.
And since passive funds are always rebalancing, they'd rarely qualify.
Exactly. It puts governance back in the hands of the true long-term stewards Bogle always talked about. Now, the trade-off is you could create some illiquidity, and management could use it to insulate themselves from valid shareholder pressure.
When you step back from it all, this MicroStrategy story, it's not just about crypto or one company's clever plan. It's a huge warning signal for the whole financial system.
It is. We are shifting from a market of active discovery, where people try to find value, to a market of passive obedience, where capital just follows mechanical rules set by a few centralized gatekeepers.
They're not just measuring the market anymore. They're actively shaping it. They're deciding who gets to play.
And that's about the future of capital allocation itself.
Which leaves us with a pretty provocative question to think about. Is financial innovation itself now being held captive by the preferences of these index committees and their desire for a kind of 20th century conformity?
And that's something we want you to think about. Remember, this analysis, it's all based on public information. The story's not over. So we invite you, our listeners, to share your own analysis in the comments. Are we being too critical? Are these fixes realistic?
We want to hear from you. We're always looking for collaborators to review our content too, so if you're a finance expert or a crypto native with a sharp eye for this stuff, please do reach out.
As always, keep searching. Keep the quest on.
I'm Satosha.
And I'm Satoshi.
Okay,